Let's turn now to the market action following today's hotter than expected PPI report. Treasury yields rising after the increase in producer prices and putting focus on the Fed's rate path. We're joined by Michael Green, Simplify Asset Management Chief Investment Strategist here. All right, so you just heard the economic breakdown here on set, but as you kind of pair that with your own investment strategy going forward from here, what does that look like? What would you be prioritizing?
Well, the really key component, I think your prior guest nailed it when she said things look pretty good on the inflation front. Certainly on the worker wages, we're seeing some positive information that suggests that some of the weakness that we've been worried about in the labor markets has retreated. That's a very positive sign. The biggest question that we have is going to be the one around what happens with tariffs and what ultimately happens with deportations. Those are really going to kind of define the path of treasuries going forward. In both situations, we have conflicting components. Tariffs could be potentially inflationary, and unfortunately, deportations are really going to be a negative for the housing market, which has been that component that has kept inflation numbers so much higher. So as I look towards the back end of the year, I think a lot of what we've seen in rates has been simply a repricing of a very aggressive move that has occurred. I'm not sure that I would interpret anything that's happening in the rates market as anything other than a fairly substantial give back of that on the recovery in the economic conditions that your prior guest hit on.
So, Michael, how should investors then be thinking about the investment landscape right now, whether or not some of that momentum, especially the Trump trade, does it have legs? It sounds like it does.
Well, I think that there are elements of the Trump trade that could very well have life. The question on the markets itself, the equity markets are at extremely high valuations. At the same time, people are being offered yields in 10 years and 30-year bonds that now actually in many ways allow them to meet many of their retirement goals. We're seeing expectations continue to bubble up. We're seeing surveys that suggest investors' expectations of long-term returns are rising. All else equal, that suggests to me that we should be very cautious about equity exposure, and we should look at much of what we're seeing in the fixed income world as an opportunity to de-risk portfolios while still earning a very attractive return.
It sounds like you're really focused and kind of trying to make sure that there's a barbell approach to where there is risk opportunity that will see reward versus where you would just like to make sure that you're kind of taking advantage of, even if it might not be the sexiest trade out there, one of the most stable trades out there. How are you kind of making sure that you're diversifying even in an environment while also making sure that you're taking on some risk?
Well, I think you nailed it when you said the barbell portfolio, because ultimately what you want to have is you want to maintain some of that beta exposure. You want to make sure that you're not, panicking and running out of equities. But at the same time, the extraordinary gains that we've seen with the S&P up 25+% for the year and over the past several years having delivered a near record performance, a lot of that has been on the back of valuation expansion. We just have not seen the earnings come through in the manner that was projected. If we go back 2 years ago, we were supposed to be at $270 in the S&P for earnings at this point. Instead, we're looking more like $220. So a lot of the expectations that are built into equity markets suggest that this is an element of mania that's catching hold at this point. And if you're going to play that, play it with some safety. Take advantage of the fact that implied volatility is relatively low. Consider owning calls rather than stocks, and don't neglect that fixed income portion of your portfolio.
Michael, what about the crypto side of things? You've got Bitcoin on this relentless rally and march higher, now right just below that 91,000 level. Is that an area that investors should be looking to gain a little bit more exposure to?
Well, I have to be very candid. I've been very negative on Bitcoin. Clearly, the price appreciation has been extraordinary, but that has come, unfortunately, on the back of flows coming from retail. So we are seeing evidence that the ETFs are being used for exit liquidity for other holders of Bitcoin. Ultimately, we still do not have a use case for it or the opportunity to generate any returns associated with this underlying product. And as a result, it really just boils down to a question of, do you think that you can get out before the next person does?
Okay, and so is there still, as we're kind of looking at 90,000 Bitcoin, 90,000 US dollars at least for Bitcoin this morning, what needs to happen? Because it kind of comes back to what you were talking in terms of the valuations that have run so fast and so quickly, and now the growth into some of these valuations. What do you think needs to happen then within crypto for it to actually validate what we're seeing right now at one Bitcoin for $90,000?
Well, there are two components that could ultimately end up happening here. One is that Bitcoin was originally designed as a peer-to-peer payment system. It has failed in that front. It is not used for peer-to-peer payments. It is banned in many places for a variety of reasons, the fraud component being one of them. The issue that leaves effectively the component that people are angling for at this point, that it becomes a leverageable asset, that theoretically your stock of Bitcoin could be lent to somebody else who wants it or needs it in some way. And unfortunately, that becomes just a circular logic, because if it's not ultimately useful for payments, then it becomes a question of what do people actually need it for. There's plenty of collateral out there in the world. US Treasuries are obviously sitting at the base of that right now. The Bitcoin play and America's embrace of it is a very odd one if we decided that we ultimately wanted to undermine our own positioning in terms of the reserve asset. So we'd have to see that component ultimately play out.
Michael Green, it was great to get your insight here this morning. Thanks so much for joining us. Simplify Asset Management Chief Investment Strategist.